Welcome to another episode of the Financial Armor Show. My name is Brad Cooper, the President and CEO of Cooper Financial Investments. And as always, I want to welcome my amazing co-host, Tony Shore. How are we doing, Tony?
I am so good. If I was any better, my name would be Keith Gangl. That's how good I'm doing. That's how good I'm doing. If I was any better, my name would be Keith Gangl, our guest today. We'll get to that. But I've had a great week. I love this time of year, spending it with family, the holidays. How about you, Brad? Now, you've been really busy. You've been jet setting around, going to a lot of financial conferences and meetings.
Yes, it's been great. Last week, I was actually a small commute to Scottsdale, which was nice for a few days of training. Then over to California for training, which was great. Had the opportunity to speak to about 30 advisors, but more importantly, just sit back and be a sponge to all the updates of what's going on in our economy and financial planning. So it's been a lot of fun. Now I'm back home for the rest of the year, looking forward to Thanksgiving, looking forward to Christmas. And as I look out in front of me, I'm seeing our beautiful Christmas tree. My wife really got carried away a couple weeks ago and put up all of our Christmas decorations.
They're already up. It's not even Thanksgiving yet, Brad, as of this recording.
And you know, most of our listeners know I'm originally from Missouri, born and raised, been in Arizona for 10 years. Probably one of the biggest challenges, and I know, Tony, you can relate to this, and Keith as well, being from Minnesota, when you're Christmas shopping, putting up Christmas decorations, and it's 75 degrees and sunny outside, it's just a little bit different. You expect cold, snow.
Yeah.
Yeah, that doesn't sound like Christmas to me, Brad.
No, but I like the weather down there a lot better than up here, especially come January, February.
Yeah, January and February, you guys, you don't know how good you got it.
Yes, we do. And
you do. Okay, you do. You do.
And I'm reminded by all my heroes and mentors like you two and others up in Minnesota that anytime I ask to come down to Arizona in January, February, I never hear a no. It's always yes. But come July, August, you can never fit in your schedule.
No. Yeah, well, my schedule's pretty full up in July and August to come to Arizona, Brad. But if you want to, January, February, and March, Keith and I will be down. Yeah, you just say the word, we'll be down there.
Looking forward to it. But yes, as we're going into the holidays, and I'm really excited. And Tony, I know you are too, because we have been very fortunate and blessed to have on some of the, in my opinion, smartest people in the financial industry. Last week's recording with Ed Slott, and this week, which I just want to quickly introduce. In my opinion, is one of the top money managers on Wall Street, has a track record. I don't want to age him too much, but let's say it's more than 25 years, right? And just his experience, in this industry. And I grew up, I was an athlete, and a lot of times results matter. And the results that Keith has received being a money manager, helping out with portfolios, and in my opinion, my favorite portfolio, and one that we recommend to all of our clients, including myself, he is the manager on and has really done better than the S&P 500 the last several years, which is amazing. But Keith, I just want to thank you for your time today. I know you're very busy, coming off an election, all the interviews you're doing, and all the work and the changes. So speaking of election, which thank God we're over, and hopefully smooth sailings, probably here's the $1 million question we get, the $1 million question we ask you: what's going to happen now? What's going to change? Are we going to see markets, climb, fall? Are we facing a recession? Are we facing a boom?
No, I like the position where we are. I mean, we talked about pre-election. Everybody's worried that, it'd be a long drawn out process, right? We wouldn't know who the winner was. There was a clear winner that night, whether you like who won or who didn't win. The market liked the fact that there was a clear winner, right? And then on top of that, the one thing that I'm sure you talked to your clients about the last several years, or last year anyway, has been these tax cuts that were in place from 2017 18, they were actually sunsetting in 2025. I think that was a very underappreciated, market potential headwind for next year, not this year, but for next year. As we were going to go through next year, everybody be looking at the end of 2025 and tax rates were going to be going up. So that now with the red wave, with Donald Trump winning, the Senate flipped from Democratic to Republican control, and looks like the House is going to narrowly stay into the Republican control. That should give a nice clear runway of, the tax policy staying. I think what's going to happen is this extend what the current tax situation is. Trump was talking about, the other thing for your investors, there's a lot of policies that get promised, not a lot of them get delivered. I do think the one thing that he can do is extend the current taxes that are in place. Now we talked about lowering corporate and lowering individuals as well. I don't. Maybe he can do that. We'll see. But as an investor, as a PM, I'm more than happy just to have them stay where they're at and not have that fear of them going up, right? Which would take money out of companies' pockets. Your company would have taken money out of a lot of people's personal pockets as well. And again, we like to look at what drives the overall market. Ultimately, we think it's company earnings. So company earnings would have been impaired as well if tax rates would have been raised. So that's why I think that was the biggest win of the night, the fact that we can see a clear pathway to taxes staying where they're at.
No, I agree 100%. And the conversations we have daily with our clients and with the help of our CPA team and tax experts, we're doing a lot of tax planning and a lot of uncertainty out there as far as December 31st, 2025 goes, up until just a few weeks ago. And now, after consulting the Ed Slots of the world and other tax experts, they're optimistic, but they said, yes, taxes may stay, where they're at for the next 4 years, but that really doesn't solve the problem that we are facing. And so as we look in the future, what concerns do you have, Keith, as far as what we may encounter, what may impact the stock market? Since really it may not be taxes now, but in the future. I know the national deficit, which I just had an alert in the last week, it went over $36 trillion.
Yeah, with a T, right? That's crazy.
With a T, crazy. So
that's real money, even to you, Keith. I think that's
real money. And I'll take a step back. I mean, you're asking the exact right questions. Your clients should want to know the answers to, but there's always issues in the market. Remember, if we go back a couple of years, it was inflation. Inflation, typically is around 2%. That rose pretty quickly to 9%. That's what kind of spooked the market. So that was unforeseen. And all of a sudden that started to poke its head up. And that's why the market sold off pretty aggressively in 2022. Now we've had some nice, back-to-back years. Last year, the markets, when I say markets, I'm talking about the S&P 500. That was up about 25%. This year to date now, after the election, we're almost up 26, 27% again in the overall market. So things are pretty positive, but there's always some fears, right? Prior to election was, okay, now who's going to get elected? We were talking actually pre-election that we'd wanted gridlock, which I generally think is, then there's no big policy changes. And so now you're going to say, okay, well, we didn't get gridlock and you're talking red wave. Are you still going to be positive? I said, I think so, just because of the tax issue. I think that's the number one thing that was a big concern for everybody. Again, if you're a financial advisor, if you're a client, anything that affects your pocketbook, which ends up impacting, your spend, which we ultimately want to look at corporate earnings, and that's what's going to drive the overall stock market. So your question is, what's going to happen in the market, or what do I, think the tailwinds are? Consumers are working. Unemployment rate's at about 4.2%. When consumers are working, they have money in their pockets, they will spend. The U.S. consumer, they don't. I mean, look at you. You got your Christmas tree up already. You're going to it. Your wife's probably done some Christmas shopping. Maybe you've done some as well.
Yes.
It's just a great time, right? And again, if you're working, you'll spend. And that the U.S. consumer is about 70% of GDP growth rate. So again, if they're working, they're spending, they're driving corporate earnings. Next year, the earnings expectations, all these geniuses in Wall Street say it's about 12, 13% for growth for next year. Right. I think that's a little bit too high. This year we're, expectations going into the year were about 9, 10%. We're actually on pace to do about 11. So we actually doing a little bit better. Next year, if we can do, 12, 13, I think it's gonna be more like high single digits, say even at 8 to 10. I think that's a great backdrop for stock. So we got, GDP growth rate next year is going to be right around 2.5%. Or this year's going to finish around 2.6%. Next year's, forecast for about 2%. If we can do 2%, unemployment stays at around 4.2. We got earnings growth rate at that 8 to 10%, I think we could have a nice year next year. Now, the things I didn't talk about, because the market's always worried about things, is valuation. What you pay for the market. We're very full here at in 22 times forward PE multiple. That's just a general way of valuing the stock market. The other thing we don't know, again, about going back to Trump winning his policies, one thing that could have a potential negative impact is tariffs. That and immigration policy, that could be good or bad. You can see both sides of that. But tariffs, I don't mind if they're targeted. Now, if he goes and slaps a 60% across the board, I think that becomes a tax on consumers. Again, what drives the overall stock market is consumer spending. So if you have a tax on something, they'll spend less. That's a less. Right. So that is something we have to worry about. But I think the market's actually pretty excited today that the Treasury Secretary that he picked last week, Friday, Scott Bessent,
right,
he sounds like a very, more of a moderate. So maybe he can kind of soften some of Trump's tones on tariff. I think that would be a positive.
Yeah, I don't know if Trump's going to get away with. I don't think Trump will accomplish those two things he promised, as mass deportations and tariffs. It's easier to say those things on the campaign trail, but because he said tariffs because we wanted to hear stick it to the other countries that are sticking it to us all the time. Why don't we make them pay for this? And the other we know there's an immigration problem, but I don't see him really accomplishing that to the extent he was promising, at least. I mean, you can't they say there could be between anywhere. The estimates are between 2 or 4 million and 20 million undocumented workers in the United States. Crazy. And I don't know how I know that half my hometown, Worthington, because of the meatpacking plant, Worthington, Minnesota, if they mass deported every undocumented worker in Worthington, the population is now, it's a farm town. It used to be. But now if you did that, you'd have 56% is Hispanic of the town. And a good portion of that, they all work for basically one or two places, and a lot of them are undocumented. So if they mass deported all of them, that town would shut down. The Walmart there would have to close down. The restaurants would close down. So that could impact, you're right, that could impact the economy negatively, but I don't see that happening. I don't think they're going to accomplish that.
I think, both those will be targeted. Again, usually when politicians are campaigning, they do the broad strokes.
Right.
And if you remember, if you go back to, the market was fearful when Trump first got elected and he talked about tariffs with China. The market kind of had a little bit, bit of a wobble, but then everything back in place was fine. And what happened to those tariffs that Trump introduced in his first term? They're still around, Tony. I mean, so they haven't changed. So I mean, I think targeted tariffs are a good idea. Now, again, I just think that broad-based 60% sounds good, like you said, stick it to the other guy. But I don't think that's what's going to. I think it's negotiating tool, and I think he'll do a good job at it. And so we'll see. But the risk is that something that happens. And again, immigration policy, I think most people are, we need to find some solution. But you're right. There's certain industries that if you had that policy, they would definitely be impacted negatively.
Sure.
Yeah. Well, speaking of the economy, Keith, a big conversation we're having, and pretty exciting to see the Fed's cut rates. What are you seeing over the next maybe 6 to 12 months, and what impact can we expect that to have on the market if interest rates do decrease? Because whether it's housing, whether it's automobiles, and the list goes on, that has had a huge impact on Americans, and it's driven prices up. So
another great question is, I mean, as a portfolio manager, we like to look at company fundamentals and see how they do. But unfortunately, for the last couple of years, we've been following what the Fed's been doing, right? We had to really pay close attention, right? Because it was when inflation was, historically at that 2%, it spiked up. And the reason that the Fed got involved is the reason they raise interest rates is to slow the overall economy. And that's exactly what happens. You slow the overall economy. But by raising rates, interest rates touches every aspect of the economy. You touched on it, whether it's you're going for a car loan, whether you're going for your house, whether you have money in your savings rate. Now, the flip side, when rates are high, it's good for a part of the population that has money in safe investments. I mean, you can actually earn a little bit of interest now, relatively risk-free, whereas you go back a few years ago, that certainly wasn't the case. You almost had to pay your bank to actually have money in your savings account, right? You were getting zero. I mean, you could have the biggest amount in the savings account and you weren't earning a thing. Now with rates where they rose, and the reason that they have gone up is because the Fed started raising rates. So that's good for the savers. It's bad for the spenders. Again, spenders drive about 70% of the overall economy. So it's a fine line, right? So it's now the rates have actually, the Fed's, been cutting rates. Now to your question, what are they going to do? They made a 50 basis point cut a couple months ago. That was the first time in over 2 years, right? We were in this increasing interest rates to get inflation under control, to slow the overall economy. They've done that. Inflation's, it's still a little bit higher than it should be, but generally speaking, it's not 9% anymore. It's at 2.5%, 3%, which is a little high, and we don't like it. And you don't like it. We don't hear about these stories about exits. And you remember the stories about exit people going and paying.
Yes.
So those stories aren't around anymore. But now it's like, okay, where are interest rates going to go? So the Fed's now gone they switched from a tightening phase to an easing phase. And generally speaking, the stock market loves easier money, right? When interest rates are low, that's good for spenders. That's good for the stock market. And again, if you're on the saver side with rates coming down, you're going to have a little less, cushion than you're getting before. So they did 50 basis points. Last meeting, they did 25. Now your question is, what are they going to do for the next, 6 to 12 months? The expectations, the probabilities out in the market that they cut 50-50, that they do another 25 basis point cut at the Fed meeting before year end. If I had my way, I probably would be on a pause. Because I think the economy is strong enough, unemployment, all those positive things I was talking about earlier. I'm more worried that if we start cutting too much, that inflation ticks back up a little bit, and then they have to switch the other way. So I'd like to see them pause, which is about a 50% probability. And then after that, then the markets are saying they expect 3 cuts for next year. So anywhere from 3 to 4 for the next year. And so, and again, rates come down, expect your savings rates to come down a little bit. Now, the bigger question, which I haven't talked about yet, is what does that do for the housing market, right? Generally speaking, when rates come down, that should be positive for the housing market. But we haven't seen that recently. The 10 years is sticky. It's been around that 6.5%, 7%. And, I think that people that, built a house or refinanced several years ago when rates were at 2, 3, 4%.
Right.
It's hard to, in Arizona, I'm sure it's hard to move out of that. You may want to move, but if you have that low interest rate that you're kind of locked into, you won't move. And then all the people that want to buy a house, now they're, your rate's at 6.5 to 7. So it would be nice to get that rate lower, but I don't know. The economy is strong, which is, tied to a different, 10-year treasury yield where that's really kind of tied to. So I think, the mortgage rates, I thought they were going to come down quicker. If you would have asked me 6 months ago, I think they're going to be sticky around that, 6.5, maybe 7%. I think the key number to get the economy really going, if it actually dipped below 6%, that's kind of what you read about all these different forecasts out there. And they said if 30-year mortgages get below 6%, that would be kind of a spot where they can actually launch off from. So that's where our expectations are, that we'll see 3 rate cuts for the next year.
That's encouraging and good news. You're just explaining me, Keith. We refinanced a few years ago at 2.8.
Right? Isn't that great?
For 30 years. And
you got me beat by that one. I got 2.9. So you had to do one better me. Yes. Always.
And which that's crazy. And a lot of our clients, same situation. And I know my wife is always saying, hey, the kids are out of the house. We're empty nesters now. Let's downsize. I said, honey, we can't afford to downsize.
No, right. Same. My wife and I want to go into a 1 level where we can transition, into older life and retirement, no stairs eventually, and just live the rest of our life there and age in place. But we can't afford to with 2.9% rates. I mean,
and just so like the housing, why it's so important is because the housing market, but 15% of the overall GDP is attached to housing-related jobs, whether it's the broker, the builder, the person that's coming to remodel, all the stuff that the cabinets, the Home Depots, all the different stuff. So it's very important. So when there's no activity going on, that's a little bit of a headwind for the overall market. So it would be nice to see those rates come down. People are a little bit more freely to be able to move if they need to. But again, I mean, the double-edged sword about inflation is, if you have assets, whether it's a saver or a house, it's been nice for this inflation, right? You certainly, you two probably aren't complaining about your house value going up the last several years either, right? So that's a flip side. Now, if you don't have assets, that's where this inflation's been a real headwind, right? If you didn't have that price appreciation of your house or the bank account situation, then you are really, the person is living, day to day of their paycheck. That's where we need to see these rates come back down.
No, and on the same topic of interest rates, especially, you're right, interest rates coming down. That means bank rates, CD rates, high yield checking, savings accounts are coming down as well. So, we're asked often, and what I love about our practice, what I love with our relationship with Gradient and having you and several other money managers on our team to help, what I love is we take risk very serious. And as a fiduciary, we do a good job as far as balancing a person's portfolio. But when it comes to something a little bit more safer, I get this asked often. Well, Brad, yes, we have our money, in this portfolio, we're protected here. But what would you recommend for maybe a 1 to 3 year short term,
Short term?
account that's safe?
I'm still positive on the overall market. So I again, depends on their risk
Yes.
tolerance and where they are. I definitely, I think the bond market's going to, where it's at right now is a decent allocation. We heard a couple years ago that the 60-40 portfolio was dead, where you have 60% stocks, 40% bonds. I don't think that's dead. I think it's maybe more modified now. Maybe you have 60%, in the stock market instead of 20% being bonds. Maybe it's, or 40, excuse me, you only put 20% and then maybe 20% in like some alternatives, whether it's things like not just alternative class, but some things maybe like annuities, some buffered index portfolios, things like that, where you provide some level of safety that you're talking about, but still allow the people to participate with the market on the upside. Those are kind of great portfolio solutions right now. And again, one that you guys mentioned at the beginning of the show is the Core Select that I manage. That's
Right.
going to look and feel like a lot like the stock market. I think the market over the next 1 to 3 years is generally going to be a positive tailwind. I would think that would be the same for that portfolio as well. Again, we'll manage things, and if I'm worried about, the other question I get is, well, Keith, if you think the market's going down, what are you going to do with your portfolio? You're going to go all cash? No, we don't believe in doing that, right? More on the advisor and the client level. We'll say, okay,
Right.
we're nervous about things, and maybe that 60-40 now should be 50-50, right? So then you take some out of your stock allocation and maybe more into those safety kind of buffered products or annuities, things like that protect you from the downside. So me as a PM will have, be fully invested, but we'll buy some more staples names. We'll buy some more Coca-Colas and the Walmarts of the world. That's how, I'll manage that situation. But, I still think there's the tailwinds, and look at that. A Coke sponsorship. Where's Warren Buffett, right?
I'm bucking to get some free Coke out of this deal.
There goes your $1 million coming to you, Tony.
Yeah, it's all good. So Berkshire is gonna, next, that might be your next guest after this week there, Brad. You might get him on.
Warren Buffett.
I think we're in a good place. I mean, you do a great job with, advising your clients. You have some, that what we call green money, that's safe money, whether it's, in savings, annuities, and things like that. And then you have your managed money, and that's why we like the outlook of the overall market. But again, the markets are up 25% last year. We're up 25% plus. Generally speaking, we're in the sweet spot of the quarters. We're in Q4, which generally speaking is a good time to be invested in the market. That's always historically been the strongest quarter. So that's why we're getting closer to the year end here. We've had a nice move, especially after this election pop. We've had a nice little pop here that we'll see what happens in the next few weeks. But when I look out a year, we talked about unemployment's low, earnings are good, and GDP growth rate. Those are good things to be key drivers for the market. I think next year may be more normalized. When I say normalized, that's that 8 to 10% return.
Yes. So, one thing I want to add as we are closing up here shortly is, how thankful I am to be part of a team of money managers. I've been doing this for over 30 years now, this industry. And the last 10 years, I've been affiliated with Gradient Investments, and I've had the opportunity to meet, visit, talk to on almost a daily basis some of the smartest people, in my opinion, on Wall Street. And before that, and I challenge you, most advisors in our industry who work with the bigger firms, not to mention any names, they don't have the access to Keith Gangl, to Mike Binger, to Jeremy, and the rest of the team. And I really appreciate that. And our clients do too, because you're willing to come out and talk to them personally in big events that we do, or even a phone call. And that's unheard of in our industry today. And what gives me peace of mind and helps me sleep at night is knowing that the money they have, you treat it like your own. It's professionally managed and you're doing the best you can. And like I said earlier in the show, results matter. And I'm proud to be invested with the portfolios that you're investing in, but also, our clients as well.
Yeah, you're fantastic to work with, Brad. You do such a great job for your clients, and it's like you said, anytime that you need to hear from us or you have a question, we pick up the phone and we answer it, which is unique in our situation, right?
Yes.
We don't, whether good and bad, right? It's been good for the last couple of years, but there'll be
You're
a
right.
period when you'll get some clients that call and say, I want to talk to Keith about X, Y, Z, but we'll talk about it. We'll talk about. Hopefully, we talk them off at the ledge at that point in time.
So what you're telling me, Keith, is when we experience that next correction, if I call you, you will pick up the phone?
I will pick
I won't
up
get your
the phone.
voicemail?
Nope, you won't. I'll pick it up. I may not be as happy as pick it up as
No,
before, but I will pick it up.
It happens. 2022, these years happen, but for the most part, over the last 100 years, the markets went up. So that's what's great about it. But having somebody actively manage it, and Brad, you and Keith really do a good job. You're doing what's in your client's best interest and trying to do what's going to help them in the long run, depending on their personal time horizon. When they need the money has a lot to do with all this. But before we go, Keith, a lot of great information from you today. That's great. Brad, why don't you let our listeners know if they want a second opinion on where they're at financially, if they're not working with a financial professional, how can they get a hold of you to set up a consultation?
Absolutely, Tony. Thank you, Keith, for all the wisdom and all the information you shared with our listeners today. If you have additional questions or just want to sit down and visit over a cup of coffee, call us toll free, 888-390-5277. Again, that's 888-390-5277. Or if you have any questions, which we enjoy responding to, go to financialarmorshow.com. Again, that's financialarmorshow.com. Type in your question. If you have a question for Keith, I will pass it on. I will get you an answer. And I'm really looking forward to the next several years and our partnership, Keith. And again, thank you so much for your time.
Thank you for having me.
All right. Great show today, guys. Listeners, that does it for today's episode of the Financial Armor Show with our host, Brad Cooper, and our special guest today, Gradient Investments Portfolio Manager right here, Keith Gangl.
Thank you.